This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
On this week's show, is inflation too high or is this normal? And we're seeking paradise with perfect being the enemy of good. This week, we'll look at different periods of inflation and move on to review one firm's latest outlook for the markets for 2024. Welcome to the Wise Investor Show. I'm Chase Hinderstein, one of the team's portfolio managers. And on Thursday this past week, we got the PCE deflator data for the October period. And this is what we always refer to as the Fed's supposed favored measure of inflation. And it came in at a 3% reading, right on the nose. And this is versus last year's same period, which was a bit below the consensus estimate according to the FactSet, which was 3.1%. Now, we've been thinking a lot about inflation, and I'm not going to get too much into the recent data. Inflation obviously is way down from those 9% readings we had a year ago. The average for 2022 as a whole was actually 8%. But I do want to reflect on some perspective about inflation today. What it means for us as investors, what it means for the consumers, and why the heck is the Fed so hell-bent on targeting a 2% inflation number? Because I'll tell you, we may already be on course to get close to that, but if we stall out around here, around 3% or so, it's pretty normal, I'm saying. Actually better than typical, and if they force the issue to get us lower, to get to that stubborn 2% target, it's going to bring on some maybe unnecessary pain in the economy just to get to that perfect number they want. On the other hand, if we are seeing mission accomplished here, then we can focus on what comes next. And when I get to that later in the show, I'm going to be leaning heavily on Goldman Sachs' recently published roadmap for 2024. But I'll keep reiterating, at least the S&P 500 has already priced in a lot of this mission accomplished. Rates are going lower. So how much and how do we get to better returns going forward? The Goldman report, we'll get into that a little bit, as they themselves, in their overall market outlook for next year, gave a pretty bullish underlying outlook for the economy as a whole, but with a pretty low overall S&P 500 target number. It was like a 5% gain, roughly, maybe less from where we are today. So we'll talk about where value can be found or if it needs to be the focus in what may be the early innings of a bull market. Because if that's the scenario, despite the market not really being cheap on a valuation basis versus next year's earnings estimates here, it's 19 times next year's earnings estimate according to FactSet. But despite that, under that scenario of this burgeoning bull market run, better rates ahead, better capital markets ahead, under that scenario, we can actually expect to also see some added returns coming from valuation expansion, despite that already seemingly high valuation, not just coming from earnings and dividend growth. Now, that might seem hard to fathom looking at a 19 times already forward valuation, but the nutshell version of that, the runway to that is that 2024 will be a year that's expected to offer certainly higher than typical year-over-year earnings growth. And that's partially driven by what will be pretty easy comps versus some pretty soft quarters many companies had this year. And it also may offer expectations for improving future quarters going forward. And I mean at this point that now, in 2024, 12 months from now, expectations for the future quarters then will be ratcheting higher, maybe. And maybe most importantly, while the Fed may not really enter a cycle of extended interest rate cuts, they may offer a symbolic cut or two to take their foot off the throttle, or more specifically, their foot off the throat of the capital markets, which will more than lower the benchmark rates for interest rates, but also it'll free up the capital markets, it'll unleash liquidity, and it brings in the spreads for lending. So home buyers, and very importantly, commercial real estate borrowers, and also simply companies that are actually pretty well capitalized, but may wish to tap additional capital so they can expand. They also can access fresh capital on easier terms. This is ensured. It may not be the base case, not if you want to be conservative with your own investment capital, but this is a diagram of what a launchpad looks like. And to digress back to inflation, we got a few key data points this past week. I mentioned that PCE inflation data below expectations, riding now at 3%. We also saw consumer confidence for the November period at a reading of 102, which was higher than the FactSet estimate of 100. And then we got the November Chicago PMI report, which, as always, represents this kind of base reading of the whole economy, whether it's expanding or contracting. And it came out firing with a 55.8 reading, well into expansion territory, that so-called Mendoza line, using a baseball analogy, of 50, well above that, and above the consensus estimate, according to FactSet, that was 45.2. Now, those three data points on an island themselves, lower inflation, higher consumer confidence, and accelerating economy, well, that would be the case for a great economy, but they're not on an island. And on Wednesday, I got into a bit of a rabbit hole about historic rates of inflation. Today's first topic, right? What is normal? And I went on to get into a conversation about this data with Greg Smith as we got talking about various time frames in history and contrasting our mutual points of view, as I come at it from this economic and market investor point of view, and he's looking at numbers from a household spending and a financial planning point of view. And both are really important in our practice, and also it's important to know the difference between them. And of course, there is a correlation between the two. And this was me again thinking about, why is the Fed so stuck on a 2% number? 2% in inflation is great. It's enough to reflect and support a growing economy without it impairing it from inflation being too hot. But to base all this important monetary policy on that, what I'll say is a Goldilocks number, it just seems too idealistic for me. As I said, if they insist on getting us from here to there, it may ultimately net out to be worse as an outcome for your investments, for consumers, and so on, than maybe a 3%-ish number. So I start off by looking at what's the average inflation for the past 5, 10, and 15 years, using the Fed as a source of the CPI data. And I ran it through the most recent months, includes up until the October reading, using the 10 months this year. We got an annual average, and the 5-year average was pretty high because it included 2022, which had a much bigger impact on a 5-year number. So the average annual inflation data for the past 5 years was 4%. Not crazy, but rather high. But if we stretch that a bit further and we look at the 10-year average, it gets down to 2.75%. And we'll get to show why that's a historically low number. But even lower, if we use a last trailing 15 years, including the elevated 8% number from last year, the average annual inflation was 2.45% in the United States. Still, including that 8% number, but also then capturing some really historically low years during, if you remember, the periods of maximum Fed support through what we had was basically zero basic interest rates early 10 years ago, and as well as a long period of quantitative easing and the expenses that involves. Well, to get a feel for how low that number really is, when we got the policies that started with the great financial crisis, I averaged the period of 2008 through 2021, so just that period of zero interest rates basically, and the average inflation rate for 2008 through the end of 2021 was 1.93% per year. And maybe that's where the Fed is coming up with this number. But again, that is remarkably low for an extended period of time. So to get back on point, to think about what normal really is in the U.S., I looked at both 1950 through 2022, so it did include that final year of high inflation, and that gave us an average annual number of 3.47%, let's say 3.5%. Then I lopped off the recent Fed's period from the great financial crisis through through recent times. And I used 1950 through 2007. I want to get a period of what normal modern U.S. inflation was before the financial crisis and everything that ensued with monetary policy there. And maybe that's not fair, but that got me to 3.84% per year. That's my base case. And that's where I started chatting with Greg, and we started talking about how I think these numbers, how I think about them as they affect asset valuations and economic growth, and how he thinks about these numbers as they're reflected on average household spending rates for our clients, and how we plan for them in the financial plans for the future. Now, while the numbers trend in the same direction, the financial plan numbers and the global economic numbers, right? The price of oil affects us all to some degree. They're not the exact same thing. For example, most of our clients don't actually pay rent. They own their homes in most cases. Many cases, they're landlords. And rent makes up 30% of the CPI calculation. Now, as rents nationwide trend higher, and I looked up what I could there, according to the St. Louis Fed, since 1980, U.S. rents have risen 8.8% per year, while top-line CPI has risen 3.3%. But if you're a homeowner, you may feel less inflation over that time because you're not paying more for the cost of rent. But on the other hand, if the 100 employees or so at the restaurant you like to eat at are paying higher rent, well, then they're going to need to earn more, and your restaurant checks, one way or another, are going to trend higher. So there's a dampened effect there, but there is an effect on us all where it's less for wealthy households, but the effect isn't nullified completely. And I did this in these instances. I lopped off the first half of the 20th century. Many economists actually go out there and they use data sets that go back as far as they can. They go back to the early 19th century, if not earlier. But there are changes in our economy, notable ones. And I like to try to capture what I think of as the modern economy. And I use the period post-World War II for that for the most part. So I've eliminated the Depression era's very low extended period of inflation. But my data does include the decade of the 70s, which had for 10 years an average inflation rate of 7%. But it also includes the 1950s, which were 2%, and the 60s, which was 2.36%. So you can see it's hard to use data for short periods of time to say, well, what will the next 10 years bring? Any 10 years is highly variable, especially if we're to think about how this relates to both normally functioning capital markets and the point of this, I guess, is somewhat to your own and consumer psychology. I like that the 1950 through 2007 rate, which gives us that 3.8% number, which is higher than we're experiencing today. And most importantly, it's substantially higher than this 2% target for today's Fed. Those low periods of the 50s and 60s were pretty good times for the U.S. economy and the markets, and the 70s were not. So clearly, we favor as investors periods, and we look forward to periods that are sub 3% rather than 4% or more. But if we can settle in comfortably here at more or less 3% in most recent readings, and maybe trend a little lower, we should be surely healthy enough for the Fed to declare mission accomplished. And for the first time ever, beating inflation with monetary policy action without a recession. And if the trend does trickle down into the mid 2% or lower range, which would maybe correspond with some higher jobless unemployment rates and reason for them maybe to show the markets some love, then we can really see maybe a half a point or so of Fed interest rate cuts, quite possibly in the next 6 months or so. That's the base case for what the markets as a whole are pricing in today, and the justification for not needing to be so very insistent on first reaching that stated 2% number. Okay, moving on from this, I'm going to take a quick step away and break, but when I return, a broader look at expectations for next year and some of our initial thoughts on how to position our portfolios for it. For the Wise Investor Show, I'm Chase Hinderstein, and I'll be back with that in a moment.
Stocks and bonds are volatile, but your financial plan doesn't have to be. Have you sat down to map out an investment plan you can trust when emotions and headlines stir panic? I'm Simon Hamilton with the Wise Investor Show. Every week we discuss the latest financial trends and what investors need to know. To learn more about how to stay grounded and to become a better informed, wise investor, listen to the Wise Investor Show at raymondjames.com/The Wise Investor Group, or just find us on your favorite podcast app.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the show. As I mentioned earlier today, while the markets have priced in expectations for lower interest rates and robust earnings growth, that it may be reflected already in the S&P 500's 19 times valuations today, there is room for growth and further valuation expansion and improving liquidity as we increase our estimates for times that go beyond 2024. And also, there's potentially value to be found within the various constituent parts of the index rather than the index as a whole, which on average, the average constituent piece has not performed as well as the broader traditional S&P 500, which, as we know, is very top-heavy with some concentrated tech positions that have done very well this year, which is a story that you've heard time and time again here. That's why the equal-weighted version of the S&P 500 is only up, as of now, 4% for the year. Similarly, the Dow Jones Industrial Average is up 7% for the year, while the traditional S&P 500 is up 18% for the year. We may already see now some evidence of a normalization or a broader rally, as we saw a pretty healthy market correction in September and in October. And now for this month of November, when things are doing much better, the S&P 500 traditional version is up 8%, but the equal-weighted version of that is the same 500 companies, but the equal-weighted version is up 9% now for the month. Now, that's not much of a sample size. It's not even a full month by the time I'm recording this, but it's a good sign that this rally has been more broad-based. That's a pretty healthy sign of a healthier market. So what else might we expect for the next year? Well, today I'm going to use Goldman Sachs' answers to that question, as I'm going to borrow generously for the rest of the show from their 2024 market outlook, which they published in about the last week or so. In future weeks, we may offer some other firms' views as well, because none of them are hymn books which we use to make our absolute decisions for our portfolios. But collectively, their work helps shape our views, which are continuously evolving. So their first section focused on the achievement of a soft landing. And it touches on a lot of what I've already said on today's show, so I'm not going to go too much into that, other than they do see the soft landing and that they actually truthfully have been calling for it throughout this entire year. They've been an outlier when 10 months ago, the average estimate on Wall Street was for recession where we're sitting now. But Goldman has, as they tend to be, more bullish. And within that discussion, they look at the need now to start moving away from cash, which they say was an excellent asset to have in 2023, and to look at combining the returns of both bonds, locking in today's higher yields, and hedging against a possible slower economy, and domestic plus emerging market equities as what they call covering their upside tail, as these would be assets that would benefit from this decline or further decline in inflation. That actual allocation, of course, needs to be tweaked based upon our own evolving outlook and more specifically on individuals' needs and risk tolerances. But an important takeaway from this all for me is to start preparing for an evolution away from stashing cash as a performing asset. Now, in today's markets, well-applied cash can earn 5% or more, still having FDIC insurance on it, or you can go out and buy a 12-month T-bill right now and get 5% or more on it. But unless that's representing cash that has a designated purpose for spending on the horizon, even if it's like your emergency fund, but beyond that, we're starting the period of thinking of allocating cash that's otherwise not needed elsewhere. And per Goldman's thesis, it's either going to be to bonds, in which you would be locking in these yields now for years to come, which would also, of course, then theoretically provide more stable principal and get that yield when rates may decline. And I say stability of principal relative to riskier assets. Bonds certainly have their inherent risks, which we're not going to get too deeply into now, but they're not risk-free, but relative to stocks at least. And they project here more normalized returns from stocks of various classes over the coming many years. Goldman, they here continue that this is into their next section whereby they focus on yields on various asset classes, they say, returning to pre-GFC levels, what assets normally returned before the great financial crisis, and allocations being more traditionally rewarded rather than has been the case over the past 15 years when you've been rewarded by being in a more narrowly focused portfolio, basically piggybacking the tech stocks today. To quote them directly, quote, constructing portfolios to earn these higher yield with the right mix of exposures to tail risks and market asymmetries remains a central pillar of our investment outlook, end quote. And they go on to focus on the risks of deflation and the struggles of some foreign markets. Actually, one of the catalysts they expect for the next year, and this is repeated in many reports from various sources, many different firms, would be an anticipation of a further injection of stimulus from China as they try to get their economy heating up a bit. But what the weakness in foreign markets adds up to is a greater risk of deflation rather than inflation in their models. And that increases the odds of then, or allows the Fed to lower interest rates in the U.S. in 2024, as the foreign markets are doing the Fed's work for them. And to skip ahead a bit in their report as I wind things down for the week, they focus again on what they call the, quote, valuing duration, end quote. And that is that it's a time to add duration to portfolios, which means, again, moving off of cash and short-term instruments onto longer-dated maturities and locking in real yields that you might not have available to you in 6 or 12 months. This might be the window where you can lock in relatively higher yields and take advantage of them over many years to come. And, I always want to harken back to the oldest and earliest lessons of not guessing where interest rates are going to go. And even though I spend a lot of time on the show talking about where interest rates are going to go, this means not leveraging to thinking that we know for sure. So, we're not going to turn around and then suddenly lock in everything into 20 or more year maturities right now. But if you've been accustomed to taking the yields and liquidity and relative safety available on the short end of the curve right now, and you're more in need of the income that those assets provide rather than the need to access the principal to be spent on something in the near future, well, then the time for adding duration to bonds, bonds that are a bit further out on the maturity curve, well, that looks like the time is becoming now. They do, however, hedge a bit, and they point out that, of course, geopolitical events can certainly be poised to damage many of the outcomes in this thesis. Well, and that's, to some degree always the case. It certainly feels like they're looming now, though, larger than usual. And, we don't have Dr. Kissinger available to help us through these trials any longer. So we'll always discount the theories and in our own practice, we'll play it a bit safer, a bit more conservative than these published reports. But let's be aware that there is at least a larger pivot going on, and that there's always are ways to reasonably take advantage of them rather than just staying the course and expecting more of the same. All right, that's it for me this week. Thanks for taking some time with my latest thoughts, and let me know if you have any reaction to them. Stay warm out there, and thanks for tuning in. I'm Chase Hinderstein for the Wise Investor Show. Thank you as always.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.